Massive moves in the market today as the fear continues to spread. Although because the Fed will always be there to backstop any losses, why care? Could this simply be an opportunity to sell, or is there something going on here? Of course, with almost all trading now run by computer algorithms, it's really out of the hands of people for the most part. Any negative news might hit that panic button. The cascade can certainly begin, regardless of the event, real, contrived, big or small. Could this be the big one, or just another blip? You came here for the truth, so let me unveil that for you. Today we're going to talk about what's happening in the stock market. I'm sure you've seen it. The Dow Jones dropping by 600 points. We're going to look at that. I'm going to give you the detail you need to know. We're going to look at the economic indicators. I want to cover the charts, the articles, everything in between. Let's begin. I'm sure you were watching the markets today. If not, you can see that the Dow Jones down 600 points. It is significant. And then we will have individuals saying that, well, it's only 2%, so it is very small. Of course it is. The stock market currently, the Dow Jones, being over 28,000. It has grown tremendously over the last year, over the last 5 years, 10 years, and so on. I get that. Trust me. I get that. Anytime I ever post a video like this talking about what had happened in the market, there's always about 5 or 10 comments talking about the percentage. Look, I'm telling you right now, the percentage is 2%. One single day doesn't matter. Even if the same thing happened tomorrow, it doesn't matter. What we are seeing here is the fragility of the markets. That's the entire point. Okay, that's all. Let me move on here. Dow plummets 600 points in the worst day since August as the coronavirus fears grow. And this is what they're saying. Of course, as I mentioned in the introduction, could this simply be an opportunity for some people to get rid of some shares, taking some off the top, anything really, because the market was going up day after day after day after day, particularly in January. Nothing was phasing the market, and now here we are. Dow's biggest one-day point declines over the past 12 months. It is significant, 600 points as you see. Back in August, there was a few days that exceeded that, but on a historic basis, 600 points is quite a bit. Friday's massive sell-off ruins January barometer market signal. I thought it was interesting that they said, well, it ruined that, as if it had to be perfect, it had to be wonderful for all of those that are invested and so on, not just, look, an indicator is an indicator, whether it's positive or negative, but that's not the way they see it, that's not the way investors see it, and it's quite sad that way, because whatever the truth is, you should just take it at face value, but people can't do that. We all know that by now. Going back to 1950, when the S&P was positive in January, 86% of the time, the full year turned out to be up. The track record is even better in presidential election years. When January is up in election year, the year is up 100% at the time, with the average S&P return of 16.6%. So January is now down, so we'll see what happens historically. Of course, we have never seen this unprecedented level of Federal Reserve intervention, global central bank intervention, and absurdly low interest rates. So we'll see if this tends to be those anomalies. Only time will tell. This article is out of Reuters, and we're talking about QE Lite. That's what they're referring to with the QE4. They don't want to call it QE4, but at least they're calling it QE Lite. Jerome Powell and other policymakers have asserted their latest balance sheet expansion is a technical adjustment and not stimulus. Our Treasury bill purchases should not be confused with the large-scale asset purchase programs that we deployed after the financial crisis. Many market watchers aren't buying it, and several have dubbed it QE Lite. You can debate it all you want, but as long as the flows are increasing the size of the balance sheet, stocks are going to rise in price. And I know many people have been talking about her, Danielle DiMartino Booth. She makes a very good point. And of course, we've been talking about this for quite some time. Markets perceive things, and they may perceive things different than what you intend, but there's also a real effect. And you can see in the bottom paragraph, the S&P rose roughly 37% during both QE1 and QE3, and by 10% under QE2, which was the smallest operation of the three. It has gained 11% since the new T-bill purchases were announced. As far as I'm concerned, these two move in lockstep, but a lot of people don't want to hear that. It's scary because that means the Federal Reserve can't stop printing. They need to continue to print money in order for the stock market to rise. This chart, and I believe the next one, are out of Reuters. The Federal Reserve's balance sheet, you could see that the Fed's bond holdings are going up again, a move some are calling QE light. They break it down section by section, different type of assets in here. They've got the QE programs. Everything is on this one chart. So if you want to know, it's information I've obviously covered many times before. For those who aren't aware of the timing and so on, just hit the pause button or go to the link in the description. The stock market has performed well when the Fed expands its balance sheet. I think that's pretty clear. I think it's pretty obvious. And you can see it here mapped out. The only real question here is that as of April 2020, when they say that, maybe they're going to stop their program or maybe they're going to reduce it, how the market is going to react to that, I think that is the number one question. This is the Fed's balance sheet and the S&P, and I talked about the fact that the balance sheet hadn't been expanding at the rate that it was previously. I showed you on a weekly basis. We get the Wednesday numbers on Thursday, so I try to include that always on Thursday's video. And it was interesting because we saw them starting to diverge from each other. You could see it here. I'll pull out the highlighter. The green is the S&P 500. So we saw this going up, whereas the balance sheet was moving sideways. And of course, this is only over a period of a few weeks, but this has come down. Now, isn't it interesting? I mean, there's all sorts of events that occur week to week. Things really don't matter when you look at these two, but they always seem to find each other. It's funny the way it works. This only goes back into 2019, but you could see it basically for the last decade. In times when there's more liquidity, the S&P or the stock market in general moves up. When there's less liquidity, the markets move down. Anybody who doesn't see that is simply delusional. All right, got some economic stats for you. This is PMIs all over the place, okay? We're looking at the top one, which is the JP Morgan Global Manufacturing PMI. You go under that, you get the US, you get China, you get European PMIs and so on, all over the place, okay? So all I want you to focus on is the color as it changes from left to right. So if I pull up my highlighter, you're going to see something. Now, this is basically from July 31st, 2018 up until the end of 2019. And what do you see as you move through this way? The colors get more red or orange or yellow. And basically what we're looking at is moving from green, which is positive territory, into contraction territory. It depends on the country, of course. There's variances. I get that. But in general, it moves weaker and weaker and weaker. I've been tracking this for you. I know that you've been here seeing it all, but it's good to see it on this one individual chart. There's even the median and the average right here at the bottom, just to give you an idea. It's under 50. That means it is contracting. Some of these have actually turned up, so they hit their bottom and they've come back up since. But in general, we are still below that line. We are still in a contraction, and it's been going on since 2018. The Baltic Index down for the 8th straight week as Capesizes extend their rout. Capesize Index dropped 21 points to a fresh record low of negative 20 points, extending its losing streak to a 36th straight session. The Baltic Dry Index lost over 10.5% this week alone. This continues to get worse and worse and worse, potentially going to be worse than we saw during the financial crisis. Might be difficult to see on the chart, but we're just comparing each year. And as you can see by the red line, it's just getting worse very, very rapidly. This is showing us the Chicago Business Barometer looking very weak. I've shown you this multiple times before. Persistent weakness in this particular indicator. Some of the others have turned up, but in general, all of them are actually looking quite weak. Here you can see it's sitting at 42.9. Haven't got to this level since that 2015-2016 timeframe. And actually, in that instance, it was basically just a blip. So we'll see if this is more like what we saw during the financial crisis. I will be tracking this for you, of course. Copper posted its ugliest month decline since 2015, marking a spectacular sell-off as investors priced in fears about the economic fallout from the coronavirus. Copper's down 10% in January and stretched for a record 13-day losing streak on Friday. Oil futures have slumped 16% this month. So we're seeing a widespread contraction that's happening, not just in the stock market today, not just in copper, but there are so many different things that are happening. And if you're just focusing on what the Amazon stock is doing, you're never going to see the bigger picture. Speaking of which, you can see on the chart the $1 trillion club. That's right, Apple, Amazon, Microsoft, and Alphabet all exceeding $1 trillion in their market cap. It's unbelievable. Now, these companies here, notorious for their massive stock buyback programs, may continue to see the benefits of those as long as they keep that a policy in their companies. US market cap versus the GDP, highest ever in history. It's not surprising. This can actually go a lot higher when you think about it. We've got really, really weak GDP that's happening today, despite all the manipulation, as well as the fact that the Federal Reserve has been intervening at a rate we have never seen before. But I wouldn't worry because your inflation is really low. That's right, your inflation is extremely low. Well, all you gotta do is exclude food and energy because that's a realistic thing to do. And you can see that inflation is sitting at 1.6% for December 2019. Of course, we're looking at the PCE rate. That's the personal consumption expenditure. Now think about that for a second. Personal consumption expenditure, okay, what you have to spend money on, but we're going to exclude food and energy because it's volatile. That's right, it's volatile. And you keep hearing this every time. Volatile, food, and energy. Volatile, food, and energy. And as long as you just keep telling a lie, people eventually believe it. Of course, they could smooth this out over a 3-month period, over a 6-month period, figure out a way to do that so that it isn't as volatile because, of course, you could have shortages, you could have problems with certain crops, you could have issues, but do you simply just completely exclude them? It doesn't make any sense. This is what people have to spend their money on, and it's extremely important things. Regardless, your inflation rate's only 1.6%, so everything is totally fine. I just wanted to make that very clear. Look, as long as you ignore reality, as long as you ignore where the inflation actually is, of course, there's no inflation, 1.6%. Why not? Citigroup unveils free robo-advisor for customers with at least $50,000 at the bank. I thought this was interesting because they're offering this service for free. So now you don't even need an employee anymore to be working at this. Nobody to click those 3 or 4 buttons, and you have a program that operates for free. I don't know about the fine print and anything. I just want to show you the fact that this whole robo-advisor thing is continuing to expand. Fidelity lets clients trade fractions of stocks, battling for younger clients between the brokerage houses. Now, when you think about this, what are they trying to do? They're trying to get people who can't actually afford, for example, 1 share of Amazon. They can get 0.7 shares of Amazon. They could buy a fraction of that share. And Fidelity is happy, absolutely happy to take your money. I have no idea how this would work if everybody tries to sell at the same time. Can they actually keep up with the liquidity? I would guess not, but I don't know all the inside scoop. I don't know the details. Regardless, you can see that they're trying to grab every last penny out of people, whether it's when you go to the bank and they tell you that you are pre-approved for a new credit card or a line of credit and you are there to withdraw cash. Please stop offering me more debt. I don't want it. Or we find that people, they've been upsold on things that they never accepted. Somehow they've been approved for it. And even CBC Go Public had some information on this a little while ago I covered. We all know what's going on here. Those of us who've been paying attention, we know the truth. That's all for this video. If you found it informative, hit that thumbs up button. Don't hit it once, don't hit it twice, hit it 3 times. Thank you very much. If you want to learn about e-commerce, if you want to know what's happening with online business, what's the whole deal, I have no idea. Well, why not check it out at the AmazonGPS.com. It's completely free. Check it out. If you want to know what's happening in the financial system, everything from the foundation, the history, the asset classes, top to bottom, A to Z, I wrote everything you need to know in these 2 books. You can check them out at the link in the description if you want the audiobook, themoneygps.com. This video is absolutely jam-packed with data. If you haven't seen it already, just click on this and I will see you over there.